everyone. Thanks for tuning in. In this video, I'm going to talk a little bit about financial markets, referring to a blog post that I did a week ago. My previous video was about something else, and I don't want to. I wanted to keep the two things separate. So everything's going to be on the blog, but I'm just probably going to create a separate playlist for all the stuff that I say about financial markets. And then everything else is going to be on a different playlist. I think I'm going to play around with it, but I think that's the best way to do it. So the blog post I'm talking about is just a very short overview of some of the things that I'm looking at in markets at the moment. I entitled it with a question. I asked whether the easy money has been made, and that engendered a lot of cross comments from Seeking Alpha readers, where my blog posts are also posted. That's not unusual, but I think it'll allow me to maybe elaborate a little bit on that, and then I have two other points that I wanted to get across in terms of what I'm looking at, and then I'll finish with two recommendations. In this case, two podcasts that I think you should check out. Any case, so the chart that I used as sort of as a hook for the question of whether the easy money has been made was basically a stock to bond ratio in the US. So if you look at the 3-month stock to bond ratio in this case, which is the relative returns of stocks, the relative return of stocks to bonds, the 10-year future in this case, you can see that it troughed at minus 30% during the crash in March, and it's now made a almost full recovery, or it's made a recovery to plus 13. And those two numbers, basically, if you look at the long-term range in this index or in this sort of time series, it's basically from one extreme to the other. So that to me suggests that exactly the easy money might have been made, or at least that the rally going forward from here is not going to be as strong as initially, which is not obviously very controversial, but I just think that it's an interesting quantitative signal on its own relative to the sort of more normative debate about whether the market is getting far ahead of itself relative to the economy, which is an interesting discussion, but it doesn't really give us anything sort of quantitative to hang our hats on in terms of to say, look, so where exactly are we in terms of the rally? And just to be clear, a stock to bond ratios that on a 3-month basis goes from minus 30 or minus 33, I think, to plus 13. That's not a signal to short. If you look at that blog post, I actually back tested the signal going back to, I think, 2001, and you get, I think, 48 binary observations. And if you then take each of these observations and see what happened subsequently to the 3-month return in equities, absolute return, you actually get a slightly positive return at 5%. And that fits the story very well, I think, because that would suggest, you get 5% over the next 3 months on the S&P 500. That's much weaker than the previous 5%. Actually, underlying volatility might be a little bit higher as well. We don't know, but maybe that's a fair bet. And so that suggests that maybe now we're entering a period of consolidation. The underlying conditions for the rally to continue in risk assets, I think, is there. I understand the debate about whether markets are getting ahead of reality in the economy. I think it's an interesting debate, but it's only interesting insofar as goes that it could become politically controversial, right? This idea that you had a huge crash, which was mandated by the government, and now we're trying to mob up after it. And we're doing so in a way which kind of leaves the economy behind, but pushes financial markets higher. Well, guess what? This is what usually happened. I mean, it usually happens. If you look at financial markets and equities in particular, they usually have their strongest return profiles early on in recovery, even as the economy is weak. And so it's not really odd. What is odd, I think, is this idea that markets fell a lot, but they're almost close to their previous highs now, at least, and I would say in the context of, for example, the sort of quintessential leaders, US tech, NASDAQ, the FANGs, or whatever it is we're calling them now, they're just going to go. I mean, are they not at new highs now? I think they're at new highs, but they're just going to go, because the conditions for these things to continue to outperform are in place, and in some sense remain in place, and in some sense what policymakers are doing ostensibly to shield the economy from the damage from the coronavirus and make sure the economy comes back is basically tailor-made for the rally in these things to continue. And I'm particularly talking about the fact that these things, equities, are quintessential growth equities, and growth equities tend to be correlated with duration and a flat curve and a flat yield curve, which is exactly what we're saying. So rates low, the discount rate is low, which means that future growth and future earnings is discounted at a lower rate, which means that you can allow a higher price. And to the extent that this was a trend before COVID-19, I just don't think that COVID-19 has changed that. I think it's hypercharged that trend. So, I don't think there's nothing controversial about this, even though a lot of people might rightly say, oh man, it's crazy. Well, maybe, but I don't think it's controversial. And if you want the best evidence of this, in my view, is basically to go back to the last FOMC press conference, where Powell was asked, directly, are there bubbles in asset prices? Are assets overvalued? And he said something like, yeah, sure, it might be the case, but basically he implied this is a price that we're willing to pay in order to support the economy. We can't afford a tightening of financial conditions and the spillover into the real economy that might entail at this point, so that we just have to keep pumping, right? And for a policymaker, it's very easy to make financial markets go up and hope that some of that trickles down, and that's much easier than to prevent a restaurant from going bankrupt. Now, to policymakers' credit, they're trying to do the latter. They're trying to push money into the sectors that is where the money is needed, but in practice it's just difficult. Also, that's political, whereas central banks, they just sit around the table and agree on printing whatever 500 billion, and they buy some fixed income securities, and then you get a portfolio rebalancing effect, and stock markets go up. This is not controversial in my view, and policymakers have doubled down on the strategy that has served them quite well even before COVID-19, which is to suggest that when the chips are down, they err on the side of providing more relative rather than less stimulus. Markets are happy. There's no real inflation, so that's what they're doing. And I can't really see a change in that. Let me put it like this: given everything I've set up until this point, we know exactly what to look out for on the flip side. The flip side would be if Powell or any other key policymaker, it could be at the ECB or the Bank of England even, or the Bank of Japan, if one of them came out and say, ooh, you know what, we're now actually a little bit worried about moral hazard, we're a little bit worried about, elevated asset prices, then I guarantee you markets would sell off hugely. But, what's the over under in that? I mean, I just don't see it happening. And by the way, the final point I'd mention here, just to go back on that stock to bond ratio, is that I know that stocks and bonds have had a tendency to be positively correlated. I just mentioned myself that tech stocks were correlated to duration. But the point here is that you still have a lot of real money managers, and even perhaps even fast money managers, and they have 60-40 portfolios or some kind of portfolios that are allocated in stocks and bonds. And the reason why the stock to bond ratio is interesting to look at is the idea that when it gets stretched, you get rebalancing, and then you get more purchases of the asset that has underperformed and vice versa. That's why the stock to bond ratio, at least in my view, is still one of sort of the core short-term strategic indices to look at in terms of where the market is, even if you're not like playing the market, which by the way I'm not. I'm not trading these things myself, but I think it's interesting to look at sort of where the market is still on a short-term basis. Anyway, it follows from that, of course, that we have to discuss what's happening with the virus. Is it coming back? It certainly seems to be coming back in the US. Also, there's an outbreak now in Germany. I mean, in order to frame this discussion, I think it's probably easiest to go back to before and just to say what's happened with this virus is you've had two immovable forces which have collided. And those two forces have been something like economies have had to be locked down. but you can't lock down economies forever. It's too expensive. On the other hand, you can't just let the virus, spread, because then your health system breaks down, and if your health system breaks down, there's a good chance your economy breaks down anyway. So in some sense, how do you toe that balance? Where the way we've tried to find that balance is we've locked down March, April, most of May, and now we're trying to reopen. And as we try to reopen, the question we have to ask ourselves, and I've told my readers in my day job as chief Eurozone economist for Pantheon Macroeconomics, when I get this question, I always tell them, look, the way you have to think about this is that governments are now trying to find a politically acceptable rate of daily infections, right? And to keep it there. And one criteria for finding that rate is the rate at which we can allow the economies to reopen, but at the same time, make sure our health systems are not overpowered and overcrowded. That's basically, I would say, where we are at the moment. And obviously then at some point you hit a point where you hit a threshold in the economy where allowing, concerts and other sort of big non-socially distanced activities to take place will become difficult. It's not clear to me how governments are going to get over that hurdle. Tourism here, as we get into the summer season, is another interesting case in terms of what governments are trying to do. But again, they're always going to be informed by this idea that they'll allow to reopen, conditional on the fact that the rate of infection stays at this politically acceptable level. In Europe, I would argue, at least if you just look at the numbers, that rate of increase is about 0 to 0.5% a day in new cases, which I think is a much better number than the R number, because we've seen in Germany with this outbreak in a meatpacking plant that the R number is now 3, but that's being driven by local outbreaks. So, the R number doesn't seem very accurate to me, but hey, come find me if you're an epidemiologist and tell me I'm wrong. But it just seems to me that if you're just observing what's going on right now, new cases in Europe are rising by 0 to 0.5% a day. Economies are still reopening, and that equilibrium seems to be acceptable at this point, both for policymakers, but also for markets, and I would even say for the economy as a whole. It'll be interesting to see whether we can continue to tiptoe that line. I mean, the big question now is whether the outbreak in Germany is going to spread, and whether that's going to force them to do even sharper lockdown. If you then go to the US, I would argue that if markets are going to be worried about a new outbreak, obviously it's going to be the outbreak in the US. It seems like the states in the South, they never really took this seriously. And then they had very short lockdowns. Now they're reopening, and the virus is just spreading like a wildfire, and it looks really, really bad. The easy conclusion here basically is that lockdowns are going to be reimposed now very soon in some of these states. I mean, I just don't see how that can be avoided, and markets will probably take a dim view on this. Although again, and I'm already seeing comments on that, and this goes back to the question that I dealt with in the beginning of this video. People are saying, well, if states in the South lock down, maybe that's kind of good news, because that means you get a big fiscal package from Congress, right? Which just shows you this the craziness of the situation we're in at the moment. But it's probably true, right? And in that sense, markets are going to be supported by that kind of underlying put, is that oh my God, the numbers are really bad, but then let's turn on the TV and see how many trillions they have for us in fiscal stimulus, right? And that money is going to go, there's a lot of liquidity, and that liquidity is going to react to that. That's just the way this works, and I think we should not try to overthink this too much. The final thing I wanted to mention was the effect on the rest of the world from the fact that major monetary policymakers, but particularly the Fed, has basically just thrown caution to the wind and are basically now going, look, we're going full force QE. Rates are at zero until, I think at the end of 2022 in terms of the Fed, which is very aggressive forward guidance, but not quite yield curve control. Again, I think I've been writing a lot about yield curve control. You'll see that. And I think the Fed actually took a really, really astute midpoint between a relatively mild forward guidance and outright yield curve control, where you basically say, look, I mean, the 10-year yield, here's a cap, and we're not going to allow it to go above that. So what the Fed has done instead is that they've gone with a aggressive 30-month forward guidance. And then obviously the reality is that as you do that, that policy casts a shadow over the 5-year rate, the 10-year rate, even the 30-year rate to some extent. And so it pushes the curve down to some extent. The main risk here for the Fed has always been that if the fiscal stimulus gets too aggressive, you get a lot of issuance, and then suddenly long rates and inflation expectations start to rise, in which case, if you really want low rates on the long end, you'll have to pay up for it. Like the Fed would actually have to pay up for it, either by announcing a target or really, really starting to buy aggressively on those tenors. At the moment, though, it seems like markets are doing the work for them, and as long as that's the case, I think that they're okay. The main point, though, is that yield curve control in the U.S. with an actual outright cap would be very different from the policy we're seeing in Japan, because I think that in the US case, they would actually have to back it up with purchases. They would, because the structure of the US Treasury market is very different from the JGB market. I might do another video of that, but that's just a little preamble. Anyway, this is obviously great news for emerging markets, right? And I think if you're not a market observer, market participant, you might not exactly follow what I'm saying here, in the sense that I'm kind of assuming that you follow markets a little bit, but just think about what some emerging markets have been through over the last 12 to 24 months. I mean, you've had a balance of payment crisis in Turkey. You've had a balance of payment crisis in some Latin American countries. Obviously, Argentina is always in trouble. And now we have a Financial Times article. I'll link to that in my blog, talking about maybe emerging markets can do QE, right? I saw an article today on Bloomberg, which suggested that maybe Brazil is going to go into negative rates, because why not, right? Now, in a normal environment, the markets would absolutely torch the currency of any EM central bank that suggested this. But we're not in a normal environment. We're in an environment where the Fed is telling the world there's going to be all the dollars in the world that you want, and if you want more, we'll just print them. And in that environment, that provides a lot of cover for emerging markets central banks to basically do what no one would ever have thought would be possible for them, namely to perhaps lower rates to zero, perhaps do QE. They can draw on Fed swap lines as well and get dollars that way. So, to use an analogy that many of you will know, is right now the tide is rising, right? And there's plenty of water for everyone to go around. And obviously the follow-on from that is eventually the tide is going to come in, and we're going to know famously who's been swimming without a swimsuit. But at this point, why would you second guess an emerging market central bank that would try to follow in the footsteps of what the Fed, the ECB, and the Bank of Japan is doing? And that, I think, is a very, very interesting shift in markets, but also a completely logical shift compared to where we've been. And I think that, are there going to be a shift anytime soon? I don't think so. I think that, I think the carry trade is on. I mean, if you can find carry anywhere, that's the That's the story. And I just don't see how that shifts. Anyway, we're at 20 minutes now, so I'll just quickly move to my two recommendations for this video. My first one is the Business Investing and Policy podcast, I think. Let me just check whether I get that right. I think I did. It's an Australian podcast, and it's a general sort of yes, business, investing, and policy podcast. Yes, that's the BIP podcast. You can find it on Apple Podcast. I'll put a link on it. It's run by a chap called Paul Colgan. It has a fund manager on regularly, I think, James Whelan, and then it has our very own, on FinTwitter at least, Ken Wexler, who's a fund manager at FX Fund Manager. And I've listened to it. It's a weekly, I think, or maybe bi-weekly. I don't know. But the latest couple of shows have been really good. I think you should check it out. The latest one is with let me just see again. I want to get this exactly right. The latest one is with a professor, Gigi Foster, where they talk about, they try to do a little bit of what I've done here, but much more in more detail about whether the COVID-19 lockdowns have been good or bad, and trying to discuss that. I think actually that's a good discussion. You should check it out. You can subscribe on Apple Podcast. And the final one I want to mention is a stalwart. The clue's in the name. Odd Lots, the Bloomberg podcast with Tracy Alloway and Joe Weisenthal. I'm way behind on my listening, but that don't matter, because you can always go back and listen to some of their shows. They're really good at picking guests, and they always have really sort of quirky finance discussions. And the dynamic, sort of I would say the dynamic between Joe and Tracy is quite cool, because they often disagree vehemently about the stuff, but they kind of, but that always gets a good dynamic in the way the questions they ask the guests. They've just done as far as I know, they've done a series on LIBOR, if you're interested in that. But I think that I would even say that if you're listening to this now and you're not generally interested in finance, I think Odd Lots is a good place to start, because they have debates which are and discussions which kind of like which sucks you in because of the topic. I will say though, some of them are quite highbrow in terms of you need to kind of know your stuff. It's not just, you can't just walk in without knowing anything about global finance and markets. You'll be disappointed, but still, I think it's worthwhile for you to check out. Anyway, I think I'll leave it for that today. I think going forward, like I said in the beginning, I'm gonna keep my market space ramblings separately from my other stuff, and then I'll try every time to give you some recommendations, specific podcasts, specific articles I've read, something like that I think is interesting. All the material that I've talked about in this video, the podcast I've just talked about, the articles that I've written on my blog, and a link to my blog will be in the description of the video. So don't fret if you haven't written anything down. You can go back and find it. And then all that's left to say for me is thanks for listening, and I hope to see you again soon.